All right, let's dive into a really fascinating and pretty aggressive portfolio strategy. We're going to break down how an investor is trying to hit an ambitious 21% annual return, not by diversifying, but by going all in on just two big ideas.
So here it is. This is the portfolio we're looking at, about $207,000. And as you can see, it's anything but spread out. It's basically split right down the middle. You got 53.6% in AI and big tech, and the other 46.4% is all in crypto. Now, this isn't random. This is a very, very deliberate structure.
This whole approach has a name. It's called the barbell strategy, an idea that author Nassim Taleb really made famous. The core idea is to completely avoid that mushy, kind of average return middle ground. Instead, you put all your chips on two very different, high-conviction extremes. You're basically trading away those smooth, predictable returns for the chance at something explosive, something totally nonlinear.
And that gets us to the most crucial point here. This portfolio, well, it pretty much throws the standard investment advice right out the window. It's all about concentrating your firepower, not spreading it thin.
You know, this Warren Buffett quote really captures the thinking behind this strategy. The whole goal is to hit a 21% annual growth rate. And to do that, the argument is you just can't afford to have your money sitting in underperforming sectors like, say, utilities. You have to focus, and focus hard, on what you believe are the biggest, most powerful shifts happening in the market today.
So let's talk about the first engine that's powering this thing, that 53.6% chunk that's all in on what's basically an AI arms race. This is actually the more stable side of the barbell, if you can even call it that.
And the way they're playing it is just brilliant. It's a classic picks and shovels strategy. So instead of trying to guess which single AI app is going to win, like in a gold rush, you don't bet on a single miner. No, you sell the picks and shovels to all the miners. That's the idea here. Bet on the essential infrastructure that every single AI company is going to need.
And this slide just breaks that infrastructure bet down perfectly. You've got two layers. First, the compute layer. We're talking NVIDIA, AMD, the companies that are building the actual brains, the chips. Then you have the cloud layer, Google, Amazon, Microsoft, because they're the only ones with the sheer scale to deploy all that hardware around the world. So by owning both, you're not just betting on a company. You're betting on the entire AI ecosystem, from the silicon all the way to the service.
Okay, now for the other end of the barbell. This is the wild side, the highly volatile, but also incredibly high potential crypto engine. This is where the strategy fully embraces risk to chase that massive reward.
The key concept here is something called asymmetric upside. So what does that mean? It means you're making a bet where the potential gains are just multiples. Many, many times larger than what you could possibly lose. Yeah, could it drop 50%? Absolutely, that's kind of expected. But the target isn't some small gain. The target is a 5x or even a 10x return. That crazy volatility is almost like the price of admission for that kind of opportunity.
And this George Soros quote just nails the mindset. For this part of the portfolio, it's not about being right all the time. It's about how much you make when you finally are right. Just one huge win can completely wipe out a bunch of smaller losses. It's all about the magnitude of your winners.
But wait, it gets even more aggressive. The strategy isn't just about holding crypto directly through a spot ETF, something that just tracks the price. Nope, it's also using leverage tools, things designed to amplify the returns, and of course the losses. It's basically like strapping a turbocharger to your engine to get way more bang for your buck on the upside.
Owning these kinds of assets is one thing. But the real secret weapon to making a strategy like this actually work, it's not in the stock tickers. It's all in your head. It's about the psychological framework you bring to the table.
So you might be wondering, if the potential upside is so huge, what's the catch? Why isn't everybody doing this? What's the most common reason people fail at this? The answer is really simple, and it's totally human. They just lack sticking power. They get all excited about the idea, they build the portfolio, but then that inevitable 30, maybe 40% drop happens, and they panic. They sell at the absolute worst possible moment.
And man, this wisdom from Charlie Munger is just timeless, isn't it? The entire strategy depends on you being the patient one, who can ride out that storm, who can see that red on the screen and not flinch, knowing that big V-shaped recoveries often follow these kinds of crashes.
So this is the big mental flip you have to make. You have to reframe what volatility is. It's not a bug in the system, it's a feature. It's part of the journey.
And when you can accept those huge drawdowns as just part of the process, you become what Nassim Taleb calls anti-fragile. The chaos doesn't break you, it can actually make you stronger.
I love this analogy. It just drives the point home perfectly. Think of the stock market like a gym. A big market dip is like putting a heavy weight on the bar. It is painful, it is difficult, but surviving it, getting through it, that's what builds the muscle for the next big run-up.
All right, so let's tie this all together. Let's see how these pieces, the super concentrated assets and that tough anti-fragile mindset, come together to shoot for a very, very specific target. And there it is, 21%. The goal is a massive 21% compounded annual growth rate. Now, just to put that into perspective, the historical average for the S&P 500 is somewhere around 10%. This strategy is trying to more than double the average return of the market.
And this is where the magic of compounding really kicks into high gear. A 21% return isn't just a big number for a single year. It becomes this mathematical force that can literally double the portfolio's value in less than 3.5 years. Think about that.
Einstein's famous words really remind us why that 21% number is the whole point. It's not just about picking the right stocks, it's about letting those winners run and compound at an incredibly high rate for a very long time.
And that really brings us to the final, critical question that a strategy like this forces every single one of us to ask ourselves. To get a shot at these kinds of extraordinary returns, do you have to be willing to endure this level of extraordinary risk, concentration, and just pure psychological stress? It's something to think about.